This is Bloomberg Intelligence.
The new tools that a metaverse can bring allows you to create more immersive content.
Companies are beginning to sell less oil, more electrons.
In-depth research and data on 2,000 companies and 130 industries.
The supply chain breakdown is combining with labor shortages. Will Eastern manufacturers continue to dominate, or will there be a renewed interest in Western manufacturing?
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Hello, I'm Kriti Gupta in for Alex Steele and Paul Sweeney this week. Coming up, we're going to dig into some of the stories impacting Wall Street and the global markets with in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we look at rising rates hitting U.S. housing, plus the outlook for consumers in Europe. But first, let's look at stocks in London. For that, we're joined by Bloomberg Intelligence strategist Tim Craighead. Tim, thank you as always for joining us. It's been a fascinating time in the markets. This week alone that we have seen so many central banks come out, the Swiss National Bank on Thursday as well, surprising the entire market with a 50 basis point hike, front-running the ECB, even the BOE coming out and warning of more substantial hikes over the 25 basis points that they did rise. I'm wondering how all of this translates into the equity market. Traditionally, when we think of central banks, we think of yields, we think of currencies. We don't necessarily talk about the read-through to some of these major European indexes. Can you expand on that for us?
There's the old cliche, don't fight the Fed. And from a European perspective, it's don't fight the Fed, don't fight the ECB, don't fight the BOE, don't fight the S&B, take your pick. It's don't fight the central bank. And that's broadly the case because generally speaking, when central banks start into a tightening mode, it tends to be to slam on the brakes because they've got to take control. And that obviously has economic repercussions, which feeds into earnings. And at the same time, at the risk of stating the obvious, higher interest rates are not good for valuations. And what we're finding ourselves in at this point is a pinch point where all the central banks are starting to clearly get concerned about the inflation picture. And this folds into the immediate repercussion for valuation, because that's the immediate hit that you get into the equity markets with rising interest rates. But now there's the increased worry about recession. I think there's good reason to differentiate Europe from what you're seeing in the States. But nonetheless, the dynamic is the same.
It's interesting that you mentioned that there is this bifurcation basically between the two states, because I feel like when we're hearing about the United Kingdom lately, a lot of the questions have been about the cost of living crisis. Sure, we have record high prices for gasoline here in the States, but in the UK, there are record high prices for almost everything. It's actually a much worse situation when you look at relative earning potential. I want to zoom in and talk a little bit about the FTSE here, because this is fascinating to me that the FTSE, when I think of even arguably European equities broadly, I think a little bit more of travel exposure or banking exposure even. But the FTSE has this kind of unique component of commodity exposure. Can you expand on that for us?
So, it's a funny thing, because if you think about Europe broadly, you can sort of compare that to the U.S. in many ways, although there are definitely differences in the markets. But then when you get to individual countries within Europe, you get very different kettles of fish, so to speak. The FTSE is an intriguing sort of barbell. 70% of the market, so the lion's share, is either in big energy, think BP and Shell, or really big miners like Rio Tinto and Glencore, or you've got financials, some really big banks like HSBC, or globally oriented big consumer product and defensive companies. And that could be a Unilever, a Diageo, or AstraZeneca and Glaxo. So with that, you think just the names that I mentioned, 70% of the marketplace is either driven by commodity prices, which are spiking right now, or interest rates that are rising, which, assuming the economy doesn't really roll over, that's good for financials. It's better for better for net interest margins. or the plunging pound, which is happening, plays into the international earnings for the defensive companies that aren't really all that cyclically exposed. And so you roll this together, and the FTSE is finding itself to be exceedingly well positioned relative to Europe or the U.S. or other global major markets. It's only down a little over 4% year to date, versus obviously 20% or even a third if you look at the NASDAQ. So, 20% for the broad U.S. market. So, it's really an interesting place that we think actually has some legs to it.
This is important to me because I think when we look at American stocks, the dollar has kind of become a hurdle almost for foreign investors hopping into that market. Can you expand on the dynamic between sterling and, say, healthcare in about 30 seconds, if you will?
The thing with the pharmaceutical companies, and it's the same thing for the big staple companies I mentioned, they get the lion's share of their revenue from abroad, like 90% plus outside the UK. And therefore, if you have revenue that's generated, let's say, in the U.S., and the U.S. dollar is rising, you get that positive translation that folds back into the U.K. from an index earnings perspective. So that currency translation is a very constructive dynamic for the FTSE, which is really unusual, having 60% of revenue broadly across the index coming from abroad.
Well, a fascinating dynamic. Tim Craighead, our Bloomberg Intelligence strategist, we thank you as always for joining us. Coming up on the program, how home buying is being hit by rate hikes. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the Bloomberg terminal. I'm Kriti Gupta. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Hello, I'm Kriti Gupta in for Alex Steele and Paul Sweeney this week. The housing market is seeing increased demand, but interest rate hikes threaten to hit home buying hard, especially if you're a first-time home buyer. To discuss, we welcome Bloomberg Intelligence Senior Industry Analyst Drew Reading. Drew, thank you as always for joining us. A lot of people are warning about the housing market and it becoming just so unaffordable. But if you actually look at the supply out there of housing, there is still a housing shortage. So to what extent do these extreme moves in mortgage rates actually hurt the housing situation?
So you're right. There is a historically low inventory of available homes for sale out in the market. So certainly that does help underpin the market to a certain degree. That being said, I mean, the monthly payment on a new home is up over 50% since the start of the year. And it's not just rates. I mean, if you go back to the beginning of the pandemic, new home prices are up more than 40%, and rates were kind of the jet fuel to that fire. So rates are up more than 260 basis points this year. We saw them come in at around 5.8. They're more than double than they were last year. So, we're really seeing affordability crunch. We've already seen in the data that demand is starting to falter, and we do expect that as we move through the remainder of the year, sales are going to continue to slow.
There's a stat here in your research. Our listeners can find it on the Bloomberg terminal. Just hit BI Go. But I love this headline. First-time home buyer affordability is the worst since 2008. Of course, we're going to remember the great financial crisis of 2008, 2009. But there's so many things that are so different about the market from now. But can you draw for our audience the parallels between the two situations?
So you're right. I think it is important to point out that the market is very different now than it was back then. One is the affordability situation. Two is that underwriting has been a lot different since the financial crisis. The people who are in homes now are owner occupants. They can afford the house. Underwriting standards have gotten much more stringent over the last several years. So I think that's the biggest distinction to be made, is that you don't have buyers in there with adjustable rate mortgages who, as rates rise, are going to be forced to sell their homes, and you're going to see a rush of foreclosures onto the market. So I think that's probably the biggest difference.
The biggest difference, does that mean that you're going to start to see a lot of these first-time home buyers, or even home buyers who are maybe looking to just switch homes or relocate or work remotely, does that mean that that demand destruction becomes a little bit more long-term? They switch their consumer behavior to things like to renting, for example, or living on the road, if that's a possibility for you.
Yes, I do think that a lot of first-time buyers who tend to be more price-sensitive have been priced out of the market. You probably see them renting a little bit longer. The challenge is that prices in the rental market have risen sharply just as well. So the rental market, I wouldn't call that affordable by any means, but it's really the entire market that's going to be subject to these rising rates. Like you mentioned, somebody may be considering moving up. You have to think about, as you look at the kind of different segments of the new home market, the entry level, the move up, the luxury, and then the active adult, each of them kind of has their own variables to help them determine whether they're going to make a home purchase decision. So obviously at the lower end, first-time buyers are more rate sensitive. But then the move-up buyer who has generated a lot of equity over the last couple of years, they're still dependent upon having to sell their house to someone. So if they're not able to sell their house to a first-time home buyer, it kind of chokes off the ecosystem. And then when you start to talk about higher price points, then you start to look at the wealth effect. You think about, things like the stock market. A lot of their wealth is tied up in equities. We've obviously seen what's happened to equity markets this year. So they're more discretionary buyers. As they see their wealth decline, they're less likely to purchase.
I'm so glad you mentioned the wealth effect here, because I have to ask about simply the recession calls that you're seeing. I mean, I'm a markets gal, so for me, I've been listing a lot of recession calls that go into 2023, 2024 at the latest. They're saying, sure, it's going to be perhaps a shallow recession, but a recession nonetheless. That means reversing perhaps some of the extremely large and unprecedented moves to some extent from the Federal Reserve. But I have to ask, that quick increase in rates that you're seeing and that kind of incline that we're seeing in the months ahead versus perhaps a quick drop down into recession territory or even easing as some parts of the market are priced into, what are the ripple effects into the housing market of that potential easing that's getting priced into a recession later out on the time horizon?
So I think first of all, with affordability where it is and rates don't appear to be coming back down anytime soon. In fact, we're still heading higher. I think we're going to be in a prolonged period of an affordability-starved market. I think that persists now through whether or not we end up in a recession. Like you mentioned, there are more calls that we will get to that point probably sometime by next year. That's what history kind of shows us when we're dealing with this type of inflation. And in that environment, I think you could kind of see housing kind of continue to kind of just grind along. You'll see that with starts kind of adjusting to a new lower demand environment. And I think you'll probably see it with the home builder stocks as well. I mean, they've been down 40% to 60% year to date. But I think there's still some concern out there that, we've seen it in the equities, but we haven't seen it in the earnings yet. So that's kind of the next shoe to drop.
And I believe we have, I want to say, Lennar earnings coming up in the week ahead. I have to ask, though, about building supplies and just kind of the pass-through costs that you're seeing from some of these raw materials. How much of that is showing up in perhaps some of the new home prices? Yeah,
higher material costs has been something that builders have been battling with really since this cycle started, and we saw it obviously accelerate when the pandemic started and all those supply chain issues kind of exacerbated. Builders are having to pay up everything, from building products, which you mentioned, but other inputs as well, such as labor. There's not enough labor to accommodate all the building that has been going on the last couple of years, and then land as well. Builders have had a tough time for much of the cycle finding developed land that is ready to build on. So as that becomes in shorter supply, prices go up, and they also have to start self-developing it themselves, which means it takes a lot longer for it to come to market than it traditionally would.
A lot of factors at play when it comes to new home buyers. Our thanks to Bloomberg Intelligence analyst Drew Reading. We thank you as always. Such a crucial time for, I want to say, people of my demographic who are perhaps looking to get out of the city, live in the suburbs a little bit, finally get that home. We're going to keep you up to date on all of those things. Coming up on the program, though, is FedEx finally righting the ship? You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 100 130 industries. You can access Bloomberg Intelligence via BI Go on the Bloomberg terminal. I'm Kriti Gupta. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
I'm Kriti Gupta, filling in for Alex Steele and Paul Sweeney this week. We're here each and every week at this time, tapping into our Bloomberg Intelligence analysts, covering some 2,000 companies and 130 industries worldwide. Let's talk earnings now and the latest results over at FedEx. They're fueling optimism for the months ahead. For more on that, we're pleased to welcome Bloomberg Intelligence senior industry analyst Lee Klaskow. Lee, I feel like I usually talk to you about railroads or kind of pipelines or something like that, but FedEx is such an important story. It's also a major bellwether, and it feels like right now a lot of what at least the markets are suggesting is that we're on the brink of recession. Is FedEx perhaps sharing the same message?
Yeah, so, we don't get to hear about earnings for FedEx until June 23rd. So, when that kind of happens, what we're expecting is the company not to really provide a lot of heavy information or long-term kind of targets, because they're also hosting an analyst day at the end of June. So we think that management's going to, save some of the longer-term strategic messaging for the analyst day. But we do expect, or we hope to see, is that they get some sort of benefits from the TNT acquisition. They're finally finished integrating that transaction, which bought quite some time, around 2016, and that division has been hard pressed to kind of to prove beneficial for the company, because the company was hit by a cyber attack back in 2017. In terms of global demand, obviously they're going to probably provide a measured outlook. There's a lot of things going on that impacts demand. Right now, B2C or business to consumer volumes, which is typically e-commerce, that's been slowing. But also what's been taking that over is an increase in business to business volumes as, economies begin to open up again. And that actually has a positive mix effect on the company's earnings, because these B2B volumes tend to be higher margin businesses. And that could show up in its ground business if we're seeing, margins expansion there.
I'm really glad you mentioned those two buzzwords, volume and margins, because it kind of seems like there's almost a trade-off there. I'm looking at a previous note dated June 6th on Bloomberg Intelligence. BI Go for our listeners around the world here. Volume may decline 16% in fiscal 2022 and then increase by low single digits in the following year based on consensus. To me, that's so interesting, because on the one hand, there are these higher prices, these higher margins that can be fed on to the consumer or the shipper or whatever you call it. But at the end of the day, total volume is still declining. What is the pivot point for that to turn around?
Yeah, so the volume thing really is based on difficult comparisons, because if you think about last year, we're in the heat of the pandemic, and a lot of people ordering stuff at home. The economy was relatively in good shape, and it was really driven by consumer demand. We've heard a lot on the news about consumers kind of shifting more towards services and less on goods. Well, that's going to have an impact on what FedEx delivers. So we're not so concerned about the headline number as being, oh no, the sky is falling and the economy is heading to a deep recession. We view it as more or less, well, they had really difficult comps, and probably the next year you're probably going to see growth again in that GDP kind of range that we should expect, because the pandemic kind of pulled forward demand 3 to 5 years in terms of e-commerce demand, and a lot of that pull forward that a lot of that is probably pretty sticky, meaning that people that might have not been comfortable ordering grocery online, or just regular retail things online, or consumer staples online, now they might be more apt to do it. Obviously they're going to go to the store more than they did during the pandemic, but it might be kind of a hybrid way of shopping versus one or the other.
We've got about a minute left here. Let's talk about the international part of FedEx's businesses. I'm looking at FA Go on the Bloomberg terminal. About 30% of their 2021 revenue actually came from their international business. In this era of COVID lockdowns in China, supply chain issues, tariffs that still exist for a lot of countries, actually, and even sanctions with the war in Ukraine, I have to ask how much of their international business is under threat right now.
So what's interesting at FedEx is that, they have, like I mentioned earlier, they bought a business called TNT, and that was finally integrated. And that's going to provide them with to better compete in Europe and lower its cost base while providing a deferred service option for shippers in the region, and also provide them with a lot more scale to better compete against UPS and DHL. They're still going to be the number 3 player in Europe, but, they've kind of narrowed that gap between the number 2 and number 3 player in Europe. Obviously, the Europe economy is a little more fragile than here in the U.S. Obviously, they're dealing with, the war in Ukraine is obviously having a major impact, and so is the Chinese lockdowns. But yeah, to your point, there is more risk there in Europe, but relative to the other carriers that I mentioned, they're less exposed.
Fascinating stuff. Of course, we're going to keep an eye on all things FedEx and the bellwethers, all this recession talk. Lee Klaskow, our Bloomberg Intelligence analyst, we thank you as always. Coming up on the program, the outlook for consumers in Europe. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the Bloomberg terminal. I'm Kriti Gupta. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
I'm Kriti Gupta, filling in for Alex Steele and Paul Sweeney this week. Let's head to Europe now, where rising prices and supply chain issues tied to the war in Ukraine are hitting sentiment hard. Who better to talk about this than our Bloomberg Intelligence credit analyst, Louise Parker. Louise, thank you as always for joining us in London. We are really looking here at a week of a lot of volatility in the markets. I'm a markets gal, so this is the lens I like to look at. A lot of this coming from central bank decisions, and a lot of this coming from currency weakness. I think when we look at the markets, from my perspective at least, we look at it from such a high level, but we don't actually talk about what that means for the average American, the average Brit, the average European. And that's really where I want to start here, because as we talk about, say, the pound becoming weaker and weaker, or the euro getting weaker and weaker, unable perhaps as these central banks try to catch up to inflation, can you expand on what that does to the purchasing power of things like fuel, food prices, travel?
What we've seen is really kind of a perfect storm in the consumer, in the economic world, but also when it boils down to not just the companies that I cover in the consumer and retail space, but what the consumer is feeling. So we've seen consumer confidence just absolutely plummet across Europe and also in the US, where we have rising prices, rising input prices for companies, rising energy prices for customers in their homes, rising gas prices at the petrol pump. And everyone is feeling that. This week we've had increasing interest rates again, both in Europe and across in the US, with the Fed raising rates by the largest amount since 1994. And the customer is not immune to this. We haven't yet seen this play out in earnings for companies as they've reported. We haven't yet got the second quarter numbers that'll be coming through in the next 4 weeks. But what we're hearing from the companies that we follow is that the second half is going to be tough, and the consumers are absolutely going to feel it in their hip pockets. Their real disposable income is shrinking, because even though we've seen wages increase, it just can't keep up with inflation. Inflation in the States is over 8%, 8.6% in May. UK inflation for April was 9%. That's a 40-year high. And in the EU, across the 27 states, inflation in April was 8.1%. Now, what we see is that people still have spending power because they had pent-up demand from COVID, from being locked down. There is a return to travel. So this summer, people are buying clothes, so apparel will do well for their summer holidays. Every Brit likes to go abroad for a 1 or 2 week holiday, typically in August. So they will still have this spending power, but what they will notice is that their real income and their savings are declining. So we're worried about the second half and what that looks like for our companies.
You use that buzzword, inflation. It's also so important. It's driving, I think, almost every conversation on Wall Street and really around the world. But to me, there's two kinds of inflation. There's the pre-war inflation and the post-war inflation. The idea of food prices, commodity prices, oil prices higher off of the war in Ukraine, the developments there. But then there's the pre-war inflation, the idea of China lockdowns, higher shipping costs. Can you speak a little bit, we have about a minute left here, into how this all translates into the costs and what people are seeing when they, say, pay their bills?
Well, the energy pricing spiking across Europe and globally is really largely directly related to Ukraine. Russia was basically supplying the bulk of gas to the rest of Europe, and we were basically dominant and relied too much on Russia. So that supply is now being turned off, and the result is that everyone, not just producers, but people in their homes, we're paying more for electricity, we're paying more for gas, and petrol and gas in your car is spiking as well. So all of these costs are increasing, and our wage growth is just not keeping up with 8-9% inflation. So we feel that. We really do feel that. And if people haven't felt it yet in the first half, we really believe it's going to happen and play into their consumer purchase decisions in the second half. So discretionary purchases. Think about your next holiday next year. You're thinking about, do I have a job next year? If people are using the R word, recession, perhaps, in 2024. And you're thinking, can I feed my kids and send them to school, private school? What am I going to have to do? And the simple thing you can do at the supermarket is to trade down to private label. Or if you're a smoker and you buy tobacco products, you trade down to a discount brand. So we'll see some of that at the edges. But if you're looking at a big ticket item, you won't buy that new car, you won't buy that new sofa. You'll actually delay those purchases.
We're going to keep an eye on all of that. Our thanks to Bloomberg Intelligence analyst Louise Parker at a very crucial time for the consumer, really, in Europe, in the United States, even in China, really around the world. This inflation story is everywhere. Up next, let's talk gardening. Well, sort of. We're looking at the fertilizer market now, where natural gas and nitrogen supply crunch is giving some producers a big advantage. For more on that, let's welcome in Bloomberg Intelligence industry analyst Alexis Maxwell. Now, this is something that we don't talk a lot about, the fertilizer market, and I'm weirdly excited about this one because, of course, I'm a markets gal, so we've been talking a lot in the markets about high commodity prices, the war in Ukraine, the ripple effects, and what a lot of people don't know is that the ripple effects are largely in fertilizer prices. That's huge for the American economy as we talk about farming here in the States. So, Alexis, I'm going to come right into you. We know fertilizer prices are skyrocketing. I believe you recently mentioned to me that there's really only second to natural gas prices, once again coming off of the war in Ukraine. But walk us through what's actually driving the price spikes.
The fertilizer price spike, as you mentioned, was really fertilizer we saw was the best performing commodity for much of 2022. And a lot of that had to do with multiple supply side shocks over the past 2 years that were really amplified by the war in Russia and Ukraine. Russia is a major low cost exporter of all of our we call them NPKs, our nitrogen, phosphate, and potash fertilizers. So we took a really tight situation and added some sort of fuel to the fire when the Western nations began to sanction and limit trade out of Russia and Ukraine back in March.
Well, speaking of the Russia-Ukraine conversation, I know there's been a lot of implications and ripple effects from the sanctions that were actually put on there. Russia's also a major player in the fertilizer market, as you point out. Can you talk to us a little bit about the limitations that sanctions have on Russia's expansion?
The Western countries did not directly sanction fertilizer producers or fertilizers. What we saw happen is we saw the terms of finance necessary for trade in commodities really start to squeeze. It was more difficult to get a letter of credit, insurance, or a vessel. We saw premiums for vessels coming out of the Baltic really rise in March and April. And now, as we've seen about 3 months pass from the crisis, we've seen people begin to export again out of Russia. Fertilizers, though, while they're coming out of Russia, volumes through May are down by about 24% compared to last year. And there's a reorganization of trade that's happening. More of Russian fertilizer is moving to non-sanctioned countries that have not sanctioned Russia, and they're staying a little bit more away from Western and North American countries.
So that's the supply side of the equation. Let's talk about the demand side, the crop demand. Of course, we know that food prices broadly are at record highs. A lot of this affecting a lot of the emerging markets and frontier markets, and of course, hitting a lot of grocery bills, both in the United States, Europe, and Asia as well. Talk to us a little bit about the demand side of this picture.
Yeah, so it's sort of a double whammy on the demand side. First, on a per ton basis, fertilizers are very expensive at the farm level. About 2 months ago, we saw fertilizer prices reach records, and that directly impacted, let's say, a corn farmer's balance sheet. You know, if a corn farmer was looking at the amount of cash that they would have to spend to plant a corn crop in 2022, normally farmers expect about 30% of their cash outlay to go to the fertilizer expense. This year, with the increased cost of fertilizers, they'd be expecting to spend about 50% of their cash outlay on fertilizers. So big increase, and the natural management technique for farmers is to cut back on their fertilizer application volumes. And when you do that, you really risk lower yields for your crop.
So, Alexis, we started off this segment with talking about these sky-high fertilizer prices. I'm curious what the timeline is here to turn that around, to make them perhaps a little bit more manageable.
This is a scenario that really took us 2 years to build up into. It's not something that we're going to be able to come out of in the next 6 to 12 months. You know, natural gas is a main input cost for fertilizer. It accounts for about 80% of your cash cost of ammonia production, which is a type of nitrogen fertilizers. We're heading into the Northern Hemisphere winter demand season for natural gas. Prices for that input cost are starting to rise, and we're expecting that the higher priced inputs will trickle through to higher priced fertilizers at least through the second half of 2023. So the timeline to get out of this scenario doesn't have any clarity, at least in the next year.
Well, Bloomberg Intelligence analyst Alexis Maxwell, we thank you as always. A fascinating story at a time when the war in Ukraine is still not only getting worse, but having ripple effects that seem to get bigger and bigger. We thank you as always for your insight. That wraps up this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the Bloomberg terminal. I'm Kriti Gupta. This is Bloomberg.